What is going on, guys? My name is Chase, and welcome back to Intelligent Money Investing. So today we're going to do three ETFs that I really like for 2019 and beyond. These are ETFs I'm adding to my positions when they're going down. Very happy when they're going up, and they're also solid dividend payers. So make sure to stay tuned. I've got three picks that I think you guys are going to be very excited about, and three picks that you guys might want to include in your own portfolios. Now, before we get into it, I do want to say that definitely do your due diligence on everything that I put forward today. Obviously, we've seen in the investing community lately that a lot of people have just been ripping the stocks from three stocks I'm buying or ETFs I'm buying. And while I think these ETFs are pretty safe to hold for the long term, more than an individual stock because it is a basket of stocks, just make sure to do your due diligence. Make sure to have conviction about your stock buys, so that way you can hold it through the ups and the downs without having too much anxiety or indifference about your picks that'll make you sell at a bad point. So, without further ado, let's get right into this. And the first one we're going to talk about is going to be one of my absolute favorites. My biggest ETF holding. I've got about, I think, 8 or 9 shares of this myself. My favorite ETF is VOO. This is the Vanguard S&P 500 ETF, and this is the heralded Warren Buffett ETF. Essentially, he wants the average person who doesn't have a ton of time to watch the stock market, research stocks, and analyze like he does. He wants those people to go into a very low expense S&P 500 index or ETF. And for that, the lowest expense ratio you're going to get is on VOO. The biggest thing about VOO is that differentiates it from things like SPY is that 0.04% expense ratio. That means that only 0.04% of the fund is taken out every year as a management fee, and that is the absolute cheapest, I believe, that you can get. If there is something cheaper, I'd love to hear from you guys down below about what you guys think about that. But as of now, this is my favorite one. There's about $400 billion under management here for this Vanguard ETF. Right now, it has about a 2% dividend yield. The year-to-date return is negative 4.5%, which to me means that it could be a buying opportunity here because we have seen that big sell-off in the S&P 500. We are kind of bouncing back right now, and as you guys can see up here, the 5-year return, it has gone from about 168 to 237. So that's a good run for the 5 years. So obviously, a little cool down is in order. We do know it just came off of the longest bull run in the stock market history, and we had that 20% downfall. So I'm not sure where the market stands as of right now, but we'll have to wait and see what happens over the next few months. So some of the biggest holdings in this ETF are exactly what you'd expect. The biggest companies in the world, we're going to start out with Microsoft with 3.62% of assets. I believe Microsoft might be the highest by market cap as of right now. I don't know how often they change the weighting of this, but it could be Amazon. I actually believe Microsoft is number 2 to Amazon right now. But obviously, it's not in exact order. And these are all fantastic companies that we have as the top holdings. So we're going to start out with Microsoft. Then number 2 is Apple, Amazon, Berkshire Hathaway. You guys know another one of my favorite individual stocks. I love talking about them, and they're, I believe, my second biggest individual stock position right now. Johnson & Johnson, very big household staple. JP Morgan Chase, Alphabet, Facebook, ExxonMobil, and Alphabet Class A. So those are all huge positions, very huge companies, and that are likely going to be very safe over the long run, and that are also going to make sure that you get a nice about 2% payout on dividends. I definitely suggest for all of these positions, if you can set it up, definitely do drip investing if you can. And what drip investing is when you take those dividends and they get reinvested right back into the company, whether the stock is up or down. Invest it right back in. That's not something that Robinhood offers as of now. I'm going to make a whole another video about why I think Robinhood hasn't introduced the drip yet, but that's definitely something to set up if you're using something like a Fidelity account or anything like that. You definitely want to compound that interest over the long run, and that's going to really help you to make a lot of money in the market going forward. So the next one we're going to be talking about is another Vanguard ETF. This is going to be VYM. It's another one of I believe it's my second biggest major index position for an ETF. I think I have like 6 or 7 shares of this, and it pays a nice quarterly dividend. This is a Vanguard high yield ETF. I believe it's only pretty much large cap stocks, so it's not any low cap stocks that have a 9% yield that are really going to go down heavily in the long run. but and that are like that aren't conservatively financed and able to sustain their yield. These are solid big companies that are paying out a higher dividend yield. The year-to-date return on this is pretty poor at -6%, but as you guys can see in the last 5 years, it has gone from 61 to 80, so that's about a 33% increase, I believe. And and all the while it has been paying out that high dividend yield, about probably what 65% higher percentage yield than the S&P 500 as a whole. As you guys see, 3.4% dividend yield versus the 2% that we saw on the S&P 500 ETFs, which is great. This one's definitely much smaller. It's more of a niche ETF, and with 29 billion under net assets, which really is nothing to scoff at. That's a pretty big ETF, especially for something that's not considered a major index. So. And while we were talking about that, the expense ratio is a little bit higher than VOO, but 0.08% is still extremely low for a fund. As you guys know, VOO 0.04%, I believe SPY is 0.07%, and really these really, like, if it's under 0.1% expense ratio, then that really is a very desirable expense ratio to get in at, in my opinion. That's very low, as a lot of actively managed funds will charge a 0.5% all the way up to like 2%. So definitely this is something to consider, and will definitely help you out when compounding your interest over the long run, because obviously while a 0.5% doesn't seem like a big deal over 1 year, but when you're holding something for 10, 15 years, then that is going to make a big difference in your total return over time. So the top holdings here, Johnson & Johnson, and we're going to see a lot of overlap for the companies that are in the S&P 500. I believe all of the holdings in VYM are S&P 500 companies, but obviously it's going to be a little bit differently weighted because it is giving preference to those dividend payers, and Johnson & Johnson is absolutely one of the biggest dividend payers on the market. So it's Johnson & Johnson, JP Morgan Chase, ExxonMobil, Pfizer, Verizon, Procter & Gamble, Wells Fargo, Intel, AT&T, and Chevron. So those are perennial dividend payers, and I'm definitely going to be making a dividend champion video going forward, and a lot of the names on here are names that have been increasing their dividends for a long time. So that gives me faith that VYM is going to continue giving higher and higher payouts and be able to maintain some of that dividend yield as the share price goes up. So that's what I've got for VYM, and the last one we have for today is going to be DIA. And one of the things that separates DIA from VYM and VOO is that it is a monthly dividend payer, and that's a really exciting thing for some of the people who are maybe nearing retirement, or just like seeing that monthly income come in. A lot of people's bills come in on a monthly basis, not quarterly, so it makes a lot of sense to have a monthly dividend payer as a part of your portfolio. One thing I'll note really quick about this is that the expense ratio is a little bit higher at 0.17%, and that's really the management fee, and because they're doing 3 times as many payouts, it makes sense that the expense ratio is going to be a little bit higher. But I really don't think 0.17% is all that high. If you guys have gone through my other videos, I have some things like SPHD and DGRW that are pretty like a 0.5% or over. So really, 0.17% is really competitive compared to a lot of other ETFs, and obviously this isn't a Vanguard, so it is a little bit higher of an expense ratio, but I really don't think that's a big thing to dwell on. So, if you guys didn't know, this is the SPDR Dow Jones Industrial Average ETF. So this is an ETF that's pretty much going to trade in line with the Dow 30 Industrial Average, and it's yielding about a 2.24% dividend yield right now, which is pretty good. It's got about 20 billion in net assets, so very comparable to VYM. This is a little more of a niche one because for some reason the S&P 500 is the index that a lot of people like to trade in and invest passively with. So a lot more people go in there, as we saw VYM, I believe we saw had 400 billion under management. VYM, it's got 29 billion under management. So DIA is actually the smallest out of the 3, with about 20 billion in net assets. And really that's not a bad thing in this case. It's actually performed excellently for me. I think it's one of my better holdings because the Dow has been very strong, honestly, in the last couple of years. The year-to-date return, it's down a little bit, 3.74%, but in the last 5 years, it has gone from 164 to 239, and that's one of the things that I really want to point out to you guys, because with a lot of the market and the videos people make these days, a lot of people have this short-term vision, and that's great if you're a trader and you're not going to hold on long-term. But for me, I'm looking at my portfolio as a basis of I want to be holding these stocks 20, 30 years from now, 5 years from now, 10 years from now, and like keep holding under the long term, compound my interest, reinvest my dividend yield, and really set myself up in positions that are going to be prosperous over the long run. So that's why I like to look at this 5 year more than I like to look at like a 6 month or a year to date. When I look at the year to date, the return, the only thing I'm thinking about is, wow, this might be a great opportunity to buy. So a lot of the top holdings here, we'll go and look at these. Boeing is the top one with about 9.34% of assets. And one of the things you guys are going to want to note here is that the percentage of assets is going to be much more heavily weighted, because I believe there is only 30 stocks in this index. So obviously when there's 30 stocks, there's going to be much higher proportions of the stocks than compared to when you have a S&P 500 with 500 different stocks in it. Then we have United Health with about 7.2% of assets, 3M, McDonald's, Home Depot, Goldman Sachs, Apple, Visa, Johnson & Johnson, and Caterpillar. So obviously these are all huge, great companies, and I believe every single one of them is a dividend payer, which kind of factors into that 2.24% dividend yield being a little bit higher than what the S&P 500 has as of now. And really, the monthly dividend, it gives you a lot of flexibility and makes this one of my favorite ETFs that I do plan to add to my position. Just for transparency's sake, I do have one share of DIA, and I have holdings in all of the ETFs that I've talked about today. I definitely plan to add to this one going forward, because I do love seeing that monthly dividend come in every single month and pay me out every single month, even when the market is down. That's one of the things that I love about dividend investing, is because even when your stock's down, as long as your dividends aren't being slashed, then you're really still performing, and it really allows you to look at the market more as what the income it generates for you, rather than just seeing your equity. And that allows you to just be confident and buy in more of those shares when the market is down, because they're going to pay you back the same amount no matter what price you buy it at. So that's what I've got for you guys today. I hope you enjoyed this video. If you did, please smash that like button, hit the subscribe button, and ring that notification bell to see more from me. All right, thank you guys so much for watching, and I'll see you in the next one.